Harry Dent, an American financial newsletter writer. His 2009 book, The Great Depression Ahead, appeared on the New York Times bestseller list. He's the man that predicted the 2008 financial crisis and also the debt bubble popping in Japan. But over the past 2 years, he's become more and more vocal to say we're heading into a financial crisis, an economic depression, and an epic stock market crash of anywhere between 85 and 90%. But in today's video, we're going to go over his latest predictions during his past 2 interviews with Stansberry Research and also Kitco News. I'll give you my reaction and analysis to it to see how likely it is to come and if it will come when he says it's going to come by March. So everyone, let's not waste any time. Let's get straight into it.
People have to realize since 2007, and I called that one 20 years before it happened, late 2007.
I think it's funny how he said he called the 2008 financial crisis 20 years prior. I think if you make prediction of a crash for 20 years, like they say, you'll most likely probably be right.
We had a peak in the stock market in late 2007, and we went into the first deep recession since the early 80s and the early 30s, okay, the Great Depression. And that's when the Federal Reserve and central bank just went nuts. We have printed more money in the last year and a half or so than all of the printing before this, and even, since 2008 and 9. I mean, just years and years of this. So they keep doing exponentially more. So they're just desperately keeping this bubble going.
And I agree with him there. They are printing more and more money each time we have a financial crisis. In the 2020 crash, they increased the money supply by 27%. That's right, all US dollars that were printed in existence, 27% of it was increased in just 2020 alone. So what this means is during the next financial crisis, they're going to have to print so much money. That could be when the US loses world reserve currency status, and that would be a big risk. And that could be the big one that leads us to this huge crash like he's warning about. Because like I said, every financial crisis, they have to print 10 times the amount they did the previous crisis.
After that, I'm going to be shocked if we do not see a downturn. So it's at the point where, to me, this is such an extreme bubble. If you're hanging in there to say, well, maybe it goes another 3 or 4 or 5 months, I'm like, get out. What my research does show 100% is that when a bubble like this bursts, you're going to see 40 to 50% crash in the first 2.5 months. And if you sit and wait for that, it'll happen before you're ready. And then you'll panic when that happens, and then it'll bounce, and then you'll look like a double idiot. So this is very tricky. And I think Baron Rothschild, the richest man of the 1800s in Europe, said, "What is the secret to my success? I always got out a bit early."
So I'm not sure if we're going to see a 45 to 55% market crash early this year. But what we did see during the market crash of 2020 is we did see a 40% drop very, very fast. And we also saw in 2018, when the Federal Reserve started lifting interest rates, we saw a 20% market crash very fast, the fastest on record. So when the crashes do come, they're getting faster and faster.
It will not take much to prick this bubble. That's what I'm saying. Now, when a major bubble of this magnitude, like 1929 or 2000 or now 2021, crashes, the whole crash tends to be about 80 to 90%. 1929 was down 89%, 78, in 2002 crash, the NASDAQ was down 78%. I'm saying stocks in general in this crash will be closer to the 29 to 32 crash. I'm estimating 87% for the S&P 500 and maybe slightly higher for the NASDAQ. So this is not something to sit through and just rebalance, as financial advisors say.
Yeah. Well, everyone, that is a big, bold prediction. He's predicting that we're going to face a stock market crash like in the Great Depression, where it fell 87%. And I bring up a chart here. We can see in 1929, the S&P 500 hit 500, and it did not recover for another 29 years till 1958. So when they say, the stock market always goes up, yes, that's been right in modern history, but when we go back to the Great Depression, it wasn't the case. It took 30 years, and then it fell down again to the same level in 1985. So that is nearly 60 years where the stock market did nothing. Now, again, I'm not saying this is going to happen. I'm not predicting this. I don't think it'll be that bad, but this is a possibility and something we have to learn from history.
You have to get out of the way of this, and then we will have the buy opportunity in investments of a lifetime. in around late 2023.
Crash will be triggered by people pulling out of cryptocurrencies. You think that that's the string that
I
starts to
think the
unravel
smart
everything?
money will start shorting stocks and cryptos, and then all these people that piled in, it's the dumb money, I hate to say it, the everyday person that piles in the last 6 to 12 months, just like in 99. And when the smart money starts selling, it doesn't take much for them because all these people are overcommitted, and then they get scared because they're not sophisticated investors. So all it takes is to get the markets to go down, I think, a little over 20%, and people will start panicking. But it takes the smart money to trigger. The dumb money is not going to trigger this. The smart money is going to say enough is enough.
So again, what he's saying there is the smart money, the hedge funds, the banks, the institutions, they're going to be the ones that are going to trigger this crash. And what have we seen with insiders recently, everyone? Well, we've seen this. Hedge funds are selling tech shares at their fastest pace in a decade as rates spike. Now, like in bull runs, when people see prices going up, it creates euphoria and it creates more and more people getting in. Well, the opposite also happens in a bear market and when prices start to go down. As they see the stock market starting to fall, this creates panic and creates more and more buyers starting to sell as they don't want to catch a falling knife. Don't want to see their balances fall lower and lower. But in this interview, I didn't see much technical reasons why the stock market is going to fall this much. He basically just went over geographical trends to say that we are in an aging population and this is going to have a huge effect on growth and the economy. And he also just goes on to say that this is just a huge bubble, valuations are too high and things have to come down, which he is right there, but it doesn't mean it'll fall 87%. But let's go over what are the biggest risks and what could possibly cause a big market crash in 2022. Like he talked about the smart money triggering a sell-off, and once things fall 20%, well, this could trigger margin calls. And I bring up a chart here of margin debt. We can see here it is at all-time highs, much higher than the dot-com bubble and much higher in 2007. But we can see here the blue line, the S&P 500, and the red line is margin debt. We can see here when the S&P 500 peaks, so does margin debt, and when it falls, so does margin debt. So right now we're at peak margin debt, but if the stock market does start to fall, we're going to see people get margin calls, and that's what makes the sell-off get worse. Now also in this interview, he'll scrutinize heavily because he's come out with many predictions like last year saying the market was going to crash in April, then June, then the end of the year of 2021, and now it's coming out to say, it's going to happen in 2022. But what he did go over, and I guess what I can kind of agree with, is the reason why it hasn't happened is because of Federal Reserve intervention. And because every time the market had dipped, the Federal Reserve will come out there and talk up the markets and add more stimulus. But now with inflation at record highs, the Federal Reserve isn't going to be there to save these people buying the dip. And it seems like investors are starting to pay attention to this because last week we had a sell-off for 4 straight days in a row. So people weren't buying the dip and we weren't seeing the rebound we normally see after a big sell-off. Now again, one of his warnings and predictions is things are just so overvalued and the market needs a correction for prices to go back to normal levels. So let's have a look to see how overvalued things are. So we look at this chart here. This is the S&P 500 Shiller price to earnings ratio. This pretty much just means how expensive are companies compared to their earnings. We can see here, before the Great Depression, prices were at 30 times earnings, and then we saw a big crash. We can also see in the dot-com bubble, that was the only other time prices were higher. And right now we are at 39. Now people, the average is actually 15 to 16. And the past 4 times the S&P 500 has gone over a price to earnings ratio of 30, we've seen a correction or drop in the S&P 500 by 20%. Also, the Warren Buffett indicator shows the stock market is now 218% of GDP. This is why the Federal Reserve is so scared of the S&P 500 falling down, because if we see a crash of 50%, that is the whole of the US GDP wiped out like that. And we can see here with the Warren Buffett indicator and the S&P 500 being 218% of GDP, this is 70% higher than the normal long-term trend. So that shows that we are due for a correction as well. Also, look at this everyone. This is the US debt. We are now nearly approaching $30 trillion. This is absolutely insane. And with interest rates likely to go up, the government isn't going to be able to spend as much as it used to be in the past because the interest costs are going to absolutely skyrocket. And this is going to drag on growth for years because the government just can't keep on borrowing and borrowing forever. They can't just keep kicking the can down the road forever. Eventually, they have to face the music, take the medicine, and just let the market correct on its own so we can rebuild from a more sustainable base. Also, like I showed you in my previous video, US consumers' debt is at record levels. And with the economy relying on so much debt, just like the government maxing out on their debt, consumers will eventually just have too much debt and they won't be able to consume more and more. And what this leads to is companies' earnings are going to fall. And if their earnings fall when their valuations at sky high levels, well, then the stock market has to fall as well. And what I'm starting to see more and more is the US economy is slowing. There's no more stimulus, and also these supply issues, they're not going away. And I'll also bring up a chart here. We can see with the pandemic not being over, consumer sentiment is starting to fall. And this has led Goldman Sachs to cut its US GDP forecast for 2022, especially with Biden's Build Back Better plan scrapped. And like I've been covering extensively on the channel, is the issues going on with China that could lead to another global financial crisis. And unfortunately, China, they're not going to let us know until after it happens. They're going to hide a lot of the data. We don't know how bad it really is. So I think it's going to take some other international bank or financial institution to be affected until we actually know how bad it really is. Also, like what happened in 2020, a black swan event. We simply don't know what could happen in 2022. There could be some other kind of event like a financial cyber attack, some other health crisis, we simply don't know. Now, going to the biggest risk of all right now is if inflation doesn't go away. Now, the Federal Reserve has said they'll lift interest rates 3 times this year, and this has obviously spooked the markets. But like I said, the biggest risk is what if inflation doesn't go down and they have to lift interest rates much higher to say 5%. This is what could cause a stock market crash of 40 to 50%. But what I think is much more likely is with high valuations and the markets having to correct with lower growth and with interest rates likely to go up 1% this year, I think it is much more likely of a stock market correction or a bear market where we see the S&P 500 fall anywhere between 20 or 30%. But like we've seen with Harry Dent's predictions, it is impossible to time exactly when these happen because the markets are 100% manipulated by the Federal Reserve. So what we could see is we could see the market start to fall to say 20%, and then the Federal Reserve could all of a sudden flip and then say, okay, we're not going to lift interest rates. We're going to sacrifice inflation to save the economy, and they could start printing money again at a rapid pace. But that leads to another issue of if they keep printing money like this, the dollar is going to become worthless, and maybe one day by 2030, like the World Economic Forum has been warning, the US could lose world reserve currency status. So everyone, what this simply means is there are huge amounts of risks. I don't think an 87% market crash this year is coming. I think something much more reasonable is 20 or 30%, but this is based on the data we have right now. Things change so much, so we have to wait and see to see if the Federal Reserve does lift interest rates. We have to see what happens to inflation and what happens in the economy. But what are your thoughts, everyone? What do you think will happen in 2022? Let me know. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll put up some other videos here. I'll see you there.